When most people hear the word stocks, they imagine a single type of investment. You buy shares, they go up or down, and that's it. But here's the truth. Not all stocks are created equal. Some belong to big, trusted companies that have stood strong for decades, while others come from small, risky firms that could either boom or bust overnight. And then there are stocks that promise rapid growth, or those that are quietly undervalued and waiting to be discovered. In this video, we're going to break down the 4 main types of stocks: blue chip, penny, growth, and value. So by the end, you'll know exactly which type suits your investing style and financial goals.
Understanding stock types isn't just theory, it's the foundation of smart investing. Every investor is different. Some prefer stability, others chase high returns, and a few look for hidden opportunities that others ignore. The type of stock you choose determines how your portfolio behaves, whether it grows steadily, swings wildly, or delivers sudden surprises. Knowing these categories helps you avoid costly mistakes and align your choices with your comfort level. So before you start picking random stocks, let's first understand what each type actually represents and how it can fit into your investment journey. Broadly speaking, stocks fall into 4 main categories. Blue chip stocks, the large, stable companies that form the backbone of the economy. Penny stocks, the small, inexpensive shares that carry high risk and high reward. Growth stocks, fast expanding businesses that focus on innovation and rapid revenue increase. And value stocks, solid companies trading below their actual worth, waiting for the market to notice them. Each of these types has a unique personality, and understanding how they differ will help you invest more strategically. Let's begin with the most trusted kind, blue chip stocks.
Blue chip stocks are the kings of the market, big, established, and dependable. These are companies like Reliance Industries, HDFC Bank, Infosys, or TCS, names that have proven themselves through decades of solid performance. They have massive market capitalization, consistent profits, and strong management teams. They pay regular dividends and are known for weathering economic storms better than smaller players. Think of blue chip stocks as the backbone of your portfolio. Steady performers that might not make you rich overnight, but will steadily grow your wealth over time.
Investors are drawn to blue chip stocks for one big reason: reliability. These companies have a track record of consistent earnings, good corporate governance, and strong reputations. Their share prices don't swing dramatically, making them ideal for long-term investors who want peace of mind. They often pay dividends, giving you a regular income along with price appreciation. They might not double every year, but they build wealth gradually, like a slow-cooking recipe that never fails. For anyone starting their investing journey, blue chips are a great foundation to build upon.
Blue chips come with clear advantages: stability, trust, and consistent returns. They're less likely to collapse during market downturns and often recover faster after crashes. However, the downside is that they grow slowly. You won't see massive short-term gains because these companies are already market leaders. Their size limits explosive growth potential. So while blue chips offer safety and steady compounding, they might not satisfy those looking for aggressive returns. The key is balance. Include blue chips for stability, but pair them with other types of stocks for faster growth.
On the other end of the spectrum, we have penny stocks, the wild west of the stock market. These are small, unknown companies whose shares often trade below rupees 10 or 20. They're cheap, volatile, and can either skyrocket or crash overnight. Many investors are drawn to them because of the dream, turning a small investment into a fortune. But behind that dream lies serious risk. Most penny stocks have little financial history, uncertain management, or unstable business models. They can give 1000% returns or lose 90% in a month.
Let's look deeper into what makes them so tempting and so dangerous.
The attraction is obvious. Massive potential. Imagine buying a 5 rupee stock that rises to 50 rupees. That's a 10-fold return. Stories like these spread fast and lure in new investors. People imagine discovering the next multi-bagger early. But what's rarely discussed are the hundreds of penny stocks that go nowhere or vanish entirely. Many operate in unstable industries or lack proper financial transparency. The reality is, penny stocks are speculative, like buying a lottery ticket. You might win big, but the odds are rarely in your favor. They're exciting, yes, but risky.
Penny stocks are infamous for manipulation. Because their prices are so low, a small group of traders can artificially pump the stock up, creating a fake rally. Once others join in, they sell their shares at a profit, leaving newcomers with losses. This is called a pump and dump. On top of that, liquidity is low, meaning it's hard to sell your shares quickly when things go wrong. Most penny stocks never grow into stable businesses. So unless you're an experienced investor who understands the risks and can afford losses, it's better to stay cautious.
Comparing blue chips and penny stocks is like comparing a commercial airplane to a stunt jet. Blue chips move slowly but safely, ideal for long flights. Penny stocks move fast and unpredictably, thrilling but dangerous. With blue chips, you earn trust and consistency. With penny stocks, you chase potential. Both can make money, but one focuses on protection, the other on speculation. Understanding this difference is key. New investors often make the mistake of chasing penny stocks without realizing the risk. Always remember, higher returns usually come with higher risk.
Next, we have growth stocks, companies focused on expanding rapidly. These are businesses that reinvest their profits into innovation, marketing, and new markets instead of paying dividends. Think of technology firms, electric vehicle makers, or renewable energy companies. They might not be huge yet, but their potential is enormous. Growth stocks are all about the future. Investors buy them expecting higher earnings and faster expansion. In India, sectors like fintech, healthcare, and EVs are filled with such opportunities. These are the stocks that could lead the next market boom. Growth stocks are exciting because they represent progress. They are the disruptors, companies bringing new ideas or technologies that change how we live and work. They often trade at higher valuations because investors believe their earnings will grow rapidly in the future. For example, in earlier years, Infosys and TCS were seen as growth stories. Today, companies in green energy or AI hold similar potential. But remember, with high growth expectations comes high volatility. If these companies fail to deliver results, their stock prices can drop sharply. Still, when chosen wisely, growth stocks can be true wealth creators. Growth stocks can reward you handsomely, but they demand patience and confidence. Their valuations often depend on future profits, so even small disappointments can trigger big price drops. But over time, great businesses that keep expanding can multiply your investment several times. The trick is to focus on fundamentals, revenue trends, innovation, and leadership quality. Don't just chase the hype. Growth stocks test your discipline. Can you hold during volatility for long-term gains? If yes, they can be a key driver of your portfolio's success.
Value stocks are like hidden treasures. These are companies that the market has undervalued, maybe due to temporary issues or simply being ignored. Their current price is lower than their true worth based on fundamentals like earnings, assets, or cash flow. Value investors, like Warren Buffett, specialize in finding these overlooked gems. They buy when others aren't paying attention, then wait patiently until the market realizes the company's real value. It's not flashy or fast, but it's a time-tested strategy that rewards patience and logic.
Value investing is about buying 100 rupees worth of value for 70 rupees. Investors study the company's balance sheets, debt, earnings, and industry position to determine its intrinsic value, what it's truly worth. When the market price is below that value, it's considered a good deal. Over time, as the company proves itself, the market corrects the price upward. Value investing requires patience. You might hold a stock for years before it shines, but when it does, the returns are steady and reliable, not based on hype, but on solid financial reasoning.
Growth and value stocks are like two sides of the same coin. Growth investors focus on future potential. They're willing to pay a higher price today for tomorrow's success. Value investors, on the other hand, look for current bargains, companies that are undervalued today but fundamentally strong. Growth is about optimism. Value is about patience. Both strategies work, but they require different mindsets. Smart investors often combine both, using growth stocks for momentum and value stocks for stability. The balance depends on your risk appetite and goals.
Choosing the right stock type depends on your personality as an investor. If you want stability and lower risk, blue chips are your best friends. If you love taking calculated risks for high rewards, you might explore penny stocks, but with caution. Growth stocks are ideal if you believe in innovation and long-term expansion. And if you enjoy analyzing data and spotting hidden value, value stocks could be your specialty. There's no single right choice. What matters is building a portfolio that matches your goals, patience level, and comfort with risk.
Smart investors rarely put all their money into one type of stock. The key is diversification, spreading investments across blue chips, growth, value, and even a small portion in penny stocks. For example, you could have 50% in blue chips for stability, 25% in growth stocks for momentum, 20% in value for long-term potential, and 5% in penny stocks for high-risk, high-reward bets. Diversification helps you balance returns and reduce overall risk. It's like mixing ingredients in a meal. Each adds flavor, but together they create the perfect recipe for financial success.
New investors often make the same mistakes, chasing hype, following social media tips, or assuming that low-price stocks are cheap. Price doesn't equal value. A 5 rupee stock isn't automatically a good deal, and a 1000 rupee stock isn't automatically expensive. Another mistake is putting all your money into one category, like only penny or only growth stocks. Always research the company's fundamentals, understand the risk, and invest with discipline. Remember, in the stock market, patience and knowledge always beat emotion and luck.
So now you know, not all stocks are the same. Balance is key to smart investing. If you found this helpful, don't forget to like, subscribe, and hit the bell icon. This is Krish signing off from Trading with Krish.